Welcome everybody to Juniper Links Accounting. My name is Caroline and today I'm going to show you how dividend tax works. So exactly everything you need to know about dividend tax, the lower rate threshold, higher rate threshold, the allowance, the rates that it's taxed at, everything you need to know is going to be right here in this video. And I'm just going to jump into my computer, you're going to tag along and we're going to check out these calculations together. So let's get started. Alright everybody, we are now in my computer. I'm gonna whip out my calculations here to show you exactly how it works. So let's go with the first example. And this is gonna be all in the lower rate. So let's say you've earned 30,000 in a salary already, and then you received some dividends from a company that you have a large amount of shares in. So let's say you earned 10,000 in dividends. One thing to remember is this is going to be the 2017-18 tax year. This is to avoid any confusion here. So 30k salary plus 10k in dividends. And this is kind of where it gets a bit interesting. So obviously your tax on the salary is going to be 20% of anything left over after £11,500. When you add on the dividends, since this is all in the lower rate, we don't have to worry about how much we've already used up. It's 40k total under the £45,000 threshold, which is the higher rate threshold. So since it's all in the lower rate, we've already used up our personal allowance. All we have to do in this case is account for the 5k dividend allowance, which is a tax-free allowance no matter what threshold you're in. And then you've only got 5,000 left that's going to be taxed at 7.5%. which is going to be, for that amount, £375 in tax. Alright, so this is like as simple as this calculation gets. Obviously, next tax year there may be a different allowance here, or there may be no allowance whatsoever, and we'll have to adjust for that as we go. But all it's really going to do is save you an extra £375 in the lower rate threshold. If we move on to example 2, this time we're going to say we've already got all of our salary taking up the lower rate threshold, and then let's say you earn another £25,000 in dividends, because reasons. And to work this one out, since it's all on the higher rate threshold, it's over £45,000, already used up all the personal allowance, but it's not gone over £100,000, which is when you start losing your personal allowance, so we're still all good there. This is, again, a simple calculation. We just have to account for the higher dividend tax rate. So once we take away the 5k allowance, we've got £20,000 in dividends that needs to be taxed at 32.5%. And that leaves us with an extra £6,500 in tax, in addition to anything deducted from your salary. In an ideal world, your salary would have already been taxed fully, as it should have been, and this is the only extra you would need to pay to HMRC. And since this liability is going to be so high, you will have a payment on account as well towards the next tax year, because HMRC assumes that you're going to earn the same level of income next year. So if you've already got this tax bill, anything over 1k as a liability, they'll ask 50% to be paid upfront with your payment by the 31st of January, and another 50% by July following. So you're going to pay like a prepayment towards next year of 6.5k as well. It's a little bit weird. I'll make a whole different video about payments on account, just because it gets a little bit confusing for some people and it's best to keep it separate. Alright, so those two examples were pretty straightforward. I mean, one we've got here, all in the lower rate, simply 7.5%. All in the higher rate, simply 32.5%, but it's not going to over any weird thresholds that we need to worry about. Alright, this time, let's say you earn a smaller salary of £10,000, and then let's say you earn dividends of £40,000. You're going to kind of see this combo in a contractor with limited company, something like that, where they're using the most tax efficient levels of salary and dividend combinations, and they're earning quite a good amount of money. So in this case, they have exceeded the £45,000 threshold in the higher rate. And what that means is now some of the dividends are going to be taxed in the higher rate and some in the lower rate. And we've got to work it out. So salary is only 10,000, so we haven't used up the personal allowance. And the personal allowance here is 11.5k. So we've got 1.5k unaccounted for, which is going to come out of the dividends. So now that we know the total is 50k, we know the higher rate threshold is 45k. So what we want to do now is essentially subtract these two figures, which is going to give you a standard figure every time. This is kind of like your base to go on. So 33,500 is what you've got remaining in that. Some of it, well, all of that is going to be dividends essentially. And 1.5k has already gone into here. So we've got to keep that in mind when we calculate the tax on this, and yeah, to get total 40k to be added up. This 33.5k is going to be taxed at 7.5%. But before we get to that, we've got to take away the dividend allowance, because that actually stacks with your personal allowance. So we take away the 5k and we get 28,500, which is taxed at 7.5%. And the tax on that will be that amount there. All right, so this is just the tax in the lower rate threshold. So now what we need to do is add up the higher rate threshold. So we know we've used up 1.5k out of here, and we used up this 33,500. So essentially we've already accounted for £35,000 of dividends out of here. So this has used up, like I said, £35,000 of dividends. But we had 40k, so there's an extra 5k we need to account for in the higher rate threshold, which we'll do here in a second. So the 5,000 in the higher rate will simply be taxed at 32.5%, which is 1625 exactly. Now all we need to do to make this work is add these two figures together, getting a total tax of £3,762.50. So that's kind of how you work out your liability when it's all split together. You'll probably find dividend calculators online, but if you want to do it yourself and want to double check that everything's correct, then this is kind of how you got to do it. And also these amounts here, that amount and this amount change every year for the most part. So this is the higher rate tax threshold, and this is your personal allowance. And this is just a tax-free amount that HMRC gives you every year. So your first amount of salary won't be taxed at 20% basically. And that is one thing we've got to remember as well, is salary always comes first when counting your tax. So salary, interest, everything like that comes first. Then dividends come basically last in any kind of calculation like this. So you always tax your salary first, and then dividends come on top of that, which is where you get the differences here and the tax liability like this. All right, in my last example, I'm going to show you guys how dividend tax works when you've got over £120,000 worth of income. This is when you lose your personal allowance. So you've got no personal allowance. You get pretty screwed at this point from HMRC. It's kind of a retarded A. I think you get what I mean. But anyway, no personal allowance in this, over 120k income. It's horrible at this rate. So this is what English people have to live with when they start earning like 150k. So I'm going to use that figure. Let's say you earn £150,000 total income, and you've only got 8,160 salary and 141,840 pounds dividends. This is kind of where it gets a bit tricky, because the personal allowance thing is a little bit more than just taking away your personal allowance. It gets a bit weirder than that. You know how you normally have your 45k threshold? That's still taken away here. Your personal allowance is still taken away from that, meaning you got 33,500 to be taxed, which is still the case. This is all you get in the lower rate threshold to be taxed, but this does not exist anymore. You don't get this against your tax liability. So what happens is you still only have 33,500 in the thresholds at the lower rate. So this all gets taxed at 20%. But on top of that, this doesn't go away. So you know how you'd normally reduce this 150k by 11,500? Yeah, that doesn't happen. So you still got this amount to get taxed in the higher rate threshold instead. So since we've got no personal allowance whatsoever now, you've got tax on this salary amount here, which is 20%, which is 1632 tax on salary, which normally wouldn't happen because you'd have your personal allowance. So we've already got this amount of tax from the salary, which has taken up some of the money here in the 33,500. So we've got to subtract that again, which gives us 25,340 that we've got as dividends in this threshold that are taxed at 7.5%. But before we do that, of course, we have to take away the dividend allowance. Always goes in first. So you got 20k now that you can take at 7.5%. At least you get that dividend allowance. That's something. All right, and now we want to add up. This is again tax in the lower rate only. So now we want to add up what exactly we've just accounted for in the lower rate. So we had this figure here is the dividends we've used up. That's it. 141,840 minus 25,340. So we've still got £116,500 worth of dividends to account for in the higher rate thresholds. Luckily, it doesn't go any higher than that. So this 116,000 is taxed at 32.5%, which is a tax bill of 37,862.50. So let's add up our tax figures here. I'm going to change the color so it's a bit more clear to see. We've got this tax figure, oh, I didn't circle that right. This tax figure and this one. So we've got 1632 plus 1525.50. Total tax 41,020. So essentially at this amount of at this amount of income, you do get ridiculously overcharged here. So 150k, most of it is dividends. Normally this would be a good deal, but once you lose your personal allowance, you really start to lose out here, because not only does it take away your personal allowance, it takes away the amount total you can have in the lower rate. So you have less money that you can tax at a lower rate than you would have done before. It's almost like a double stacking effect type thing, because normally you'd be like, oh, I don't have a personal allowance, right? So a whole 45k is taxed at, let's say, 20%, like it should be, or 7.5% if it's dividends. But it's not like that in this case. It still takes this away, but you don't get the tax relief from it. So you just have less to tax in the lower rate threshold. And I know that sounds a little bit weird, but that's how HMRC operates. And if you did have this tax bill here and this is like your first year, you weren't expecting it, you just took out a lot of dividends and you were just like, oh my God, how am I going to pay this? Not even that. But if it's your first year, like I said, those things called payments on account. So this is how it'll work. So let's say this is your liability for the 17-18 tax year. By January 2019, you will be expected to pay this amount here. The HMRC will expect you to pay this 41,020 for sure, like right away. That's what they want to take from you. In addition to that, they want to take an extra 50% of that amount towards next year. So if you guys are filling out your tax return and you suddenly see the figures jump to a ridiculous number that you weren't expecting, like £61,000, then that's why. It's not anything wrong with HMRC or anything they're doing. It's simply the fact that they want 50% upfront. So it's 50% of this is this figure here. They want that upfront because they think you're going to earn the same amount of money next year. Now, of course, there is an option to remove payments on account, but if you do this, you have to make sure that you're not going to go over that tax figure and you're going to stay at a lower rate. So you can either reduce them or remove them to zero. It depends on your income next year, so you have to be pretty confident of it, because they will be cheeky and charge you interest if your payment happens to be higher than you said it would be, and they will charge you interest because they'll count it as late and all this stuff. So it's going to be weird, and I know it doesn't really make sense, but again, that's how HMRC operates. Then they also want a second payment roughly 6 months later of this figure again. So they want the second half of the money now. And you'll be like, well, they're just taking my money, they're taking it as a prepayment. Essentially, yeah, but when you think about the dates here, so the tax year ends in between here, April 2019. So really you're paying them a few months in advance for half of the amount, and then the rest of it is after the tax year has ended. It's just like they want the money as the tax year is ending rather than a whole year later, like with January's accounts. So it kind of works like that. It's a bit weird. That's just how they wanted to do it, so they set it up like this, and we can't really do too much about it apart from be prepared for the higher tax liability when it hits, because a lot of people are surprised by the payments on account. They didn't even know that they existed. Alright guys, I hope you found this video extremely helpful. A lot of people have been asking me about how dividend tax works and everything, so I gave you the main examples that you may encounter. Obviously, the best places to stay at, whether you're a medium earner or a high earner over 100k. So if you've got your own company, for example, and you want to take out around 50k because that's how much is available, you're best off to stay within the low rate threshold. So keep it below 45k if you can. You don't really want to go into the 32.5%. Otherwise, there's other things you can do rather than waiting for next year to take out that money. Is if your partner doesn't have any other current role or anything and they want to help out with your accounts, stuff like that, then you can actually hire them as an employee and get a little bit of extra money from your company. Or you can add them on as a shareholder, of course, but there may be self-assessment implications depending on what their other income is and whether they exceed the 5k and what your share structure is and all that stuff. So there's a bit more complexity when it comes to adding them on as a shareholder. There are some complexities as well when they're adding them on as employee, such as the pension scheme, so auto-enrollment that came out. Those things are easily avoidable though. There are some things you can do there. And if you are a higher earner, you're earning above 100k and you've got your own company again, like as a contractor. If you're earning around 150k, 200k, and that's how much money you want to take out, I would probably advise to stay below £100,000 if you can. Of course, it's your money, you can take it. It's just the tax will be a lot higher. If you stay below the 100k, you won't lose any of your personal allowance. It's between like 100 to £123,000 that your personal allowance diminishes by £1 for every £2 you go over. Over 150k, you got a different tax bracket again. So if you're earning that much salary, I am sorry, but HMRC is going to take a lot of money from you. And yes, that's how dividends work. So if you've got any questions, please feel free to comment down below, let me know. Stick around for more videos. Be sure to hit that subscribe button if you're more interested in contractor accounting advice and things related to that, like VAT, PAYE, all those things. So stay tuned for more. There will be many videos on the way. Thanks a lot for taking the time to watch this, guys. Hit that like button, comment, and subscribe. Goodbye, guys.